Uganda, the central bank there has cut its main lending rate to 12% from 13%, saying there's still a need to boost economic growth in the East African economy. Policymakers over there started cutting the benchmark rate in April, bringing it back down from a peak, a frankly eye-watering peak of 17%, which was reached as a bank battled a surge in inflation. Central Bank Governor Emmanuel Tumusiime-Mutebile says that inflation is expected to edge up in the short term, but he expects it will remain roughly on course to hit its 12-month target of an average of about 5%. The Ugandan shilling is also under quite a bit of pressure due to a range of factors, both internal and external.
Given that core inflation is forecast to remain around the medium-term target of 5% over the next 12 months, and in line with efforts to keep the domestic economic growth momentum, the Bank of Uganda believes that there is scope to continue easing monetary policy.
Let's get a sense of where that country's monetary policy is heading now. Michael Beleka joins me now live from Kampala with more data. Michael, the policy rate may have been cut, but is that likely to actually translate into reduced lending costs for businesses and, reduced borrowing costs rather, for businesses and individuals? I mean, put another way, how effective really is the rate transmission mechanism in Uganda?
Well, Rama, the rate transmission mechanism comes with a lag here in Uganda. Bank of Uganda puts this between 8 to 12 months to see this translated into commercial bank rates. The central bank has come down from 17% last year in October to now about 12%. This seems like a big margin, but of course, commercial banks have only reduced their lending rate by about 2% from about 30 and 28 to now 25. And this is just a couple of months ago. Banks claim they don't necessarily use the CBR. They claim they have structural issues to deal with. And critics believe banks are like any other businesses with expenses to cover, and they should own up and probably move with the CBR.
Indeed. Speaking of what banks are doing, there was a pretty fierce debate in Uganda in September when Kenya imposed price controls and interest rates, with some in that country arguing that Uganda should follow suit to tame banks, as you just alluded to. But as credit growth slows down to virtually nothing in Kenya, are proponents of that idea of rate caps in Uganda sitting back and saying, actually, this might be a bad idea, we probably shouldn't do it?
Well, Rama, policymakers have kind of cushioned themselves a bit. They're ignoring the issue. Banks are silent. Members of parliament are not saying anything about it. But some proponents I talked to have talked and say they haven't lost steam. Discussions held a couple of months ago, commercial banks seem to fight the idea of capping interest rates. They say Uganda is different from Kenya, that the cap on interest rates cannot solve the issues of interest rates, of high interest rates. Bank of Uganda noted at one of the discussions that caps may discourage those investors intending to join the financial sector. And the price controls on interest rates may edge out small businesses, according to Bank of Uganda, which businesses are considered high risk. So, but the proponents continue to argue that that the problem of high interest rates will be solved by capping. And it is the reason that banks continue to register non-performing loans. Rama?
Indeed. We'll leave it there for the time being. Thank you for that. That's Michael Beleka, of course, in the Ugandan capital of Kampala.